Hi, and welcome to another video from the Motley Fool. I'm Owen Benelak, and I'm here with Maynard Payton from the Motley Fool website. He's the editor.
Hello, Owen.
Hi, Maynard. Now, today we are going to talk about dividends. And an interesting fact about dividends is that this year, the FTSE 100 will pay out more in dividends than it did before the financial crisis, which is a pretty spectacular statistic.
Yeah.
And everyone likes dividends, don't they?
They do.
Yep, you can get them from a FTSE tracker, for instance. You could buy an ETF. You could just capture all that gain. What if you want more dividends? You could buy high-yielding shares like AstraZeneca or the like, or you could buy an ETF that specialises in paying out more in dividends.
Yes, this particular ETF is called the UK Dividend Plus. It's a collection of 50 different shares from the FTSE 350, and it aims to pay out more in dividends than a normal tracker.
Sounds good. Who wouldn't want that?
Well, a lot of people do, but a lot of people have found out it's not the ideal way of collecting dividends or high-yield dividends as such. It's a mechanical ETF.
Oh, what's a mechanical? Is that a little box that someone cranks at the side?
Well, not exactly. It's I think someone's cranking a computer. It's someone at a computer has a list of the FTSE 350 shares and has ranked them in order of their forecast yield, and the fund itself takes the FTSE 350 takes the top 50 and invests in them.
Hold on, what's bad about that? Why wouldn't you want the highest yielding shares?
A number of reasons. I think the first one is that it's all based on forecasts,
right.
City forecasts. So what happened in the financial crash was that share prices going down, City forecasts lagged the market, really lagged reality, and the fund itself at the bottom of the banking crash was buying banks such as Lloyds, retailers such as Dixon's, house builders such as Taylor Wimpey, all at the wrong time.
It's like basically having an idiot wandering around the market buying stuff that any normal person could see.
Even worse, it was selling what you would call quality stocks such as Shell and United Utilities as well. So not the greatest of investment decisions at the time.
Right, but surely it's bounced back now.
It has bounced back, but the dividends are still well below the pre-crash level of this fund. So as the FTSE 100 has rallied its dividends, this particular fund has lagged that recovery as such. The way it still picks shares is not great.
Mm-hmm. What's its highest yield at the moment?
Man Group, the hedge fund company, and the difficulty there, that's its top holding. Man has indicated that it's going to pay a large dividend this year, and the shares yield something well over 10%. But has also indicated that dividends in the future will be paid out of earnings, and if you look at the current earnings from the company, there's a dividend chop on the horizon.
And the computer hasn't noticed
the computer hasn't noticed this, even though the market has, and the fund is still, I think, 4% invested in Man.
Okay, well, I have a theory about this, Maynard, which is that possibly, well, definitely this fund has done very badly, but surely at some point it will do better. And I'll tell you why, because they did back test it, didn't they? For 20 years before they set up these mechanicals, they didn't just draw them out of a hat. So surely now, as we finally move beyond the financial crisis, it will finally go to the sunny uplands. I'm not so sure. I'm just not so sure about any sort of mechanical system. You've got to need a bit of intuition. If it was all down to computers, successful stock picking was all down to computers, it's the person who would have the best computer would be the richest person in the world. Is that like Bill Gates?
Yeah.
He made some computers, that's how he did it. Well, okay, I happen to agree with you. I'm just being provocative for the sake of a two-way discussion. If you do want to look into the dividend ETF we've been talking about, the ticker is IUKD. Personally, I would look at a basket from the FTSE 100, from a tracker, maybe buy AstraZeneca or Shell.
So a selection of your own high-yield shares, I think, and a little bit of your own common sense, and not too much dependence on City forecasts.
Yeah, I think that's good advice. Okay, thanks very much. We'll see you again soon.